Somewhere inside a billion-dollar portfolio, a loan is sitting on a spreadsheet that no one has verified in months. The collateral backing it, real estate, receivables, structured paper, may be pledged to two lenders simultaneously. Or it may not exist at all. This is not a hypothetical. It happened in the United States with auto lending firms. It happened again in the United Kingdom with a mortgage servicer called Market Financial Solutions. And the specific structural pattern did not stop there. What follows is not a story about fraud. Fraud is the surface. Beneath it is a plumbing system that was built over the last decade to route credit around the formal banking sector, and that plumbing is now under pressure it was never designed to sustain. After 2008, regulatory constraints changed how aggressively major banks could lend. They could still originate loans in certain categories, but the deep, speculative, high-yield lending that once funded everything from leveraged buyouts to subprime pipelines had to go somewhere else. It went into private credit, business development companies, direct lending funds, specialty finance firms that borrow from institutional lenders and redeploy that capital into markets the big banks prefer not to touch. The spread between what they borrow at and what they lend at is the business. The collateral backing those loans is the system's foundation. When volume becomes the priority and verification becomes secondary, the foundation develops fissures that don't show up until stress arrives. The stress has arrived. Blue Owl Capital announced asset sales across 3 funds and restricted redemptions from one of them. New Mountain Finance moved to sell assets in a sequence whose pricing and timing carried more urgency than an orderly portfolio optimization would suggest. KKR's business development company disclosed that its non-accrual rate, loans where the borrower has stopped paying and recovery is unlikely, rose from 2.9% to 3.4% in a single quarter. In a leveraged portfolio, that half percentage point increase is not modest. The stock fell 15% on the announcement. Management described the issue as a handful of specific loans. The market's response suggested it did not find that reassuring. Then came MFS. Market Financial Solutions was a UK-based mortgage servicer that borrowed from major Wall Street institutions and deployed capital into construction and real estate lending. It encountered funding difficulties over a weekend, failed to arrange bridge financing, and was in bankruptcy by Wednesday. What emerged? Approximately $1.2 billion in loan exposure, backed by roughly $230 million in verifiable collateral. Double pledging, using the same collateral to secure multiple lenders simultaneously, is alleged to account for a deficiency of more than 80%. Firms including Jefferies, Barclays, Wells Fargo, Apollo, and Banco Santander are among those with exposure. The compounding detail is this. After earlier U.S. cases involving fraudulent and non-existent collateral, major Wall Street institutions formed task forces specifically to detect this behavior. They implemented new protocols, they ran additional reviews, they still missed MFS, which means either the detection systems are inadequate or the incentive to close transactions continues to override the incentive to scrutinize them. Both possibilities point to the same conclusion. The population of undiscovered cases is not empty. The argument offered by fund managers, isolated incidents, specific loans, broader portfolio sound, fails on structural grounds. Private credit lacks transparent market pricing. Losses accumulate quietly and are acknowledged only when they can no longer be deferred. The publicly traded BDCs are the one window into an otherwise opaque system, and across that window, Blue Owl, KKR, the BDC index, prices have been moving in one direction. The Franco Liberty Senior Loan ETF, which tracks leveraged loans and was historically uncorrelated to the BDC sector, has been tracking it since early 2022. That correlation means the perceived deterioration is no longer confined to shadow banking. It is beginning to enter adjacent credit markets. High-yield spreads are widening. European insurance companies have begun publicly distancing themselves from private credit, the first institutional step in a process that, if it continues, ends with the asset class being treated as something sophisticated capital avoids rather than seeks. The yield curve is registering this. The 2-year Treasury has been pressing toward multi-year lows near 3.40%. The 10-year has fallen below 4%. The SOFR futures curve, contracts reflecting expectations about short-term rates at various future points, shows the market assigning increasing probability to an eventual Fed response, while keeping the front end elevated because that response does not appear imminent. The arithmetic: if the curve completes a standard uninversion to roughly 200 basis points of spread and the long end holds near current levels, the short end would need to fall toward approximately 2%. In 2008, the 2-year did not reach 2% until after Bear Stearns failed. The market is not predicting that sequence. It is pricing it as a scenario with material and growing weight. Primary dealer behavior reinforces the signal. As of the most recent reporting period, primary dealer holdings of Treasury notes and bonds reached a record $423 billion and accumulated steadily since mid-December, during the same period when the mainstream narrative was that conditions were stabilizing. European banks reported the second-largest single-month increase in government bond holdings on record in January 2026. The only month with a larger increase was in 2010, at the start of the second Eurodollar crisis. UBS revised its adverse case estimate for private credit losses upward, placing potential losses in a stress scenario at approximately 15%, and noted that the estimate had shifted substantially in a short period, suggesting the underlying conditions were deteriorating faster than the model's prior parameters anticipated. The institutions with the most direct visibility into the credit system are reducing exposure to corporate credit and accumulating high-quality collateral. The public commentary says one thing, the positioning says another. The deeper structural issue is this: the shadow banking sector grew to fill a vacuum created by post-2008 banking regulation. The banks that retreated from direct lending did not eliminate the demand for that lending. They outsourced it to intermediaries that borrowed from those same banks and deployed capital into markets the banks preferred not to touch. The exposure never fully left the banking system. It was intermediated. The collateral risk, the credit risk, the fraud risk, channeled through vehicles designed to look institutional but not subject to the same capital requirements, disclosure obligations, or regulatory oversight as the banks themselves. When those vehicles encounter stress, the question of how much migrates back to the funding banks, and from there to the broader financial system, is the central structural question of the current moment. The question that the data cannot yet answer is whether what is unfolding represents a bounded correction in an asset class that expanded too quickly, or whether it is the visible edge of a broader repricing whose full contours are not visible from inside the system. The institutions adjusting their positioning appear to be treating that question as genuinely open. Their behavior suggests they are not confident about the answer, and that the cost of being wrong in their assessment is not symmetric.